And once again, welcome to the Legal Business Structures and Public Benefits Considerations webinar, presented today by Phil Truax, Taliba Bales, and Molly Sullivan. The content of this webinar were developed under Grant H421F240198 from the U.S. Department of Education Department. The department does not mandate or prescribe practices, models, or other activities described or discussed in this document. The contents of this webinar may contain examples of adaptations of and links to resources created and maintained by another public or private organization. The department does not control or guarantee the accuracy, relevance, timeliness, or completeness of the outside information. The content of this webinar does not necessarily represent the policy of the department. This publication is not intended to represent the views or policies of or be an endorsement of any views expressed or materials provided by any federal agency. And once again, we are honored to be joined by an outstanding panel of experts who bring deep experience in business formation, financial management, and entrepreneurship. First on our panel presentation, we will have Phil Truax, attorney at Truax Law Group. Phil, the floor is yours.
All right. Thank you so much. Good afternoon, everybody. We've got a nice panel and a nice set of content for everybody as we all look at starting a business. I'm going to walk us through some legal features in starting a business and forming an entity. And we're going to talk about the different types of entities that you as a business owner can use in creating your business, and really what does that mean when we talk about entities. And that'll dovetail into a conversation about how benefit programs can count as business income and assets, and how those work with different types of business entities, well, they're also called corporate forms, and then how those different entities impact tax obligations. So our panel here will be talking about a number of those issues here, and I'm going to start with corporate forms or entities. So we can go to the next slide. There's several different types of businesses that are out there. Many of you have seen businesses with Corp or Inc. at the end, or LLC or LTD. And all of those abbreviations signify the different type of company that company actually is, whether it's a sole proprietor or a partnership, or a limited liability company or a corporation. There's a whole lot we could talk about here. So the point here is to give you a nice overview of what these different business entities are and what they mean and what the differences are. So the first is a sole proprietorship. That is where you have one business owner that owns the company, but there's actually not a separate entity for that business. It is Phil Truax practicing law as Phil Truax, and I may call the business Truax Law, and I may have a trade name for Truax Law, but there's not a separate business entity. There's not a LLC or a corporation or a partnership that really is Truax Law. Truax Law is just Phil Truax. So one of the benefits of that is it's simple. There's not a whole lot of regulatory or registration needs when you're a sole proprietor, maybe registering a trade name for the name of the business, but otherwise, it's a simple, straightforward way to set up a business and to keep accounting, financials, books. So that's one of the benefits. One of the drawbacks is that it often subjects your personal assets to any liabilities of your business. So one of the most important benefits of having an entity, a business entity, a corporation or an LLC, is that the law views that entity as a separate legal person, separate from the human being, in this case, me, who's owns the business. And that separate person, that separate legal person, in my case, I have an LLC, Truex Law Group Ltd is actually what the business name is. And the business, the income and the liabilities, the debts, if you would, are under that LLC. And that provides some protection to me personally in that circumstance. So with a sole proprietorship, you don't have that. It's all under the business owner's name, social security numbers, bank accounts, assets of the individual are subject to those liabilities. So with the benefit of simplicity comes the added risk. There's also a partnership, which, needless to say, you have to have more than one person to have a partnership. A partnership, by its very nature, is two or more people who've decided to come together and form a business. That's another simple form, usually requires a partnership agreement, a document that governs between the two partners how they're going to run the business, how they're going to distribute money at the end of the year, who makes decisions, who owns what percentages of the entity, that kind of thing. So it's a simple form of a company. There is a different entity involved there, but sometimes with partnerships, in fact, generally with partnerships, the liabilities, the risks, the debts flow to the partners. There's different types of partnerships, like a limited liability partnership, which provides a little bit more protection for the owners. There's also something called a limited partnership. A limited partnership is where you have a general partner, the person who, generally speaking, owns all of the majority interest in the business and makes all the decisions. By the very nature, the general partner makes the decisions for a limited partnership. And then there are limited partners, usually minority partners, partners who own less than half of the company. And the best way to think of a limited partner is that they are like passive investors. They have limited rights, decision-making rights, and they do have an ownership interest in the company, but they can make almost no decisions, if not no decisions, with limited partnerships, with limited partners. There's also a limited liability company. A limited liability company is kind of new. A limited liability company is a creation by statute, and it hasn't been around for very long. It's essentially just like a partnership, but with some added protections for the owners. So there's a lot of similarities to what I mentioned before with a limited liability partnership and a limited liability company. With limited liability companies, the owners are called members, and the shares in a limited liability company are called membership interests. But a limited liability is, again, very similar to a partnership with with some more benefits, more protections against personal liability for the owners. LLCs generally are a very good thing. There's also a lot of flexibility with LLCs. Corporations, of course, have been around for a very long time. Corporations have a lot of the same protections as an LLC. Corporations are also, though, they're regulated. They have some more formalities, some more rules that apply on what shareholders have to do when they set up a corporation. There's often requirements for boards of directors or directors generally, and then there's also officers of corporations. And then there's some advantages also of corporations. There's different types of corporations, like an S-Corp and then a C-Corp. And we'll talk a little bit more about what the differences of those are. We can go to the next slide. So one of the common questions, if you're starting a business on your own, you don't need to worry about this slide. But if you're starting a business with someone, or you expect to have a partner down the road, maybe like me, I own my law firm 100%. I started my law firm 4 years ago. I would like to have a partner someday. And so if I were watching this webinar, I would pay attention to this slide. The question is, you got to ask yourself, why do you want a partnership? Why do you want to share your business with someone? There may be lots of reasons why. One may be because that's the whole point. I wanted to start a business with my friend or my business colleague or a family member, my spouse. Um, and then there's also the idea that I need money, I need other resources, I need land, I need equipment. There may be other things that you decide that in order for me to make this business idea flourish, I need another human who I can work with, who I have to share the company with. Um, so the question then, when you have not predetermined who that partner is, that's when we get into these sub bullets that I have under partnership. Is there a good fit? What is the business philosophy? What are the values? When you have a partnership with someone, and I'm talking in the general sense of a partnership, it's like a marriage. There's a lot of time spent with the individuals, and there's a lot to share. There's a lot of decision making that needs to be done together. So choosing who that partner is in your business is very, very important. There's also the consideration of complementary or overlapping skill sets. Complementary being, I'm good at this, you're good at that. I'll be in charge of this, you be in charge of that. And that's a fine way to go about things, as long as there's a mechanism to coordinate and share information and get the proper approvals between you. There's also people that have very overlapping skill sets and they work together. All of that comes down to making sure that the company has in place a document. In the case of an LLC, it's called an operating agreement. In the case of a partnership, it's called a partnership agreement. In the case of a corporation, there are code of regulations or bylaws that make determinations of how this partnership, how this group of people is going to coexist and work together into the future. And then, of course, who owns what? What's the split? Is it a 50-50 partnership? Is it 51-49? Is it 60-40? Is it some other division of ownership? And what usually go hand in hand with that, but not always, is decision making. There's a lot of times the decision making authority is tied directly to the percentage, but not always. I've recently set up an entity for a client who owns and purchases real estate, but he set this up for the benefit of his kids, such that he only owns 2% and his two children share equally the remaining 98% of the company. But decision-making authority rests entirely with dad. Dad makes all of the decisions for this entity as far as negotiating, buying which real estate properties to buy, with the intention at some point that dad's going to hang it up and turn it over to his children. But there's many ways that you can set up an entity when you have multiple owners, like we're talking here. And then there's, of course, financial considerations. Sometimes you have two partners who are about on equal footing of their financial wherewithal, how much money they have, how many assets they have. And then you have situations where you may have one owner who has the money, and you have another owner who has what you might call sweat equity or experience, and really is going to run the business, or really has all the ideas on what needs to happen. And the partners may decide that, while I'm going to contribute $50,000 to starting up this company, you have really all the ideas and you're going to be working hard, so we should split this company 50-50, or we'll split this company 60-40. And those are decisions that need to be made up front between the partners. And then, of course, there's lots of variations between all of that. And then last, is this concept of equity, owning part of the company and owning the funds. How do you start the business? Do you need loans? Do you need to get a line of credit? Do you need to get a home equity line of credit and use money that you're actually borrowing against your house? Is there another way that you may get a business loan to start money? And how does that business loan and the obligations to pay back that loan, how is that managed? So those are just some considerations when you're talking about setting up an entity to what you need to think about when you have a partner or another owner of the business. Please, please do not go into business with somebody without thinking about these kinds of things and then writing it down. Even if you don't hire a lawyer to prepare the actual document that you should have, put it in writing. Have a piece of paper where you write these things down and you both sign it so you have an understanding. And then when you start to make a little bit of money and you can budget for legal services, then convert that into an actual legal enforceable agreement. Let's skip ahead to the next slide, which I believe is my last slide, and that's going to be tax implications here. Word of warning to everybody, this is intended to be a high level tax implications view. Everything that I'm talking about, generally speaking, is either governed by state law or significantly impacted by state law. Taxes often are federal law questions, but there's often state tax issues. And almost every state is different. So I know we have people from all over that are attending this. So keep in mind that as we talk about these things, that the different state laws are going to be very relevant to what we're getting into. So first, let's talk about the sole proprietorship. Remember, that's the entity that really isn't an entity. It's just you. You're the sole owner, and you own the business assets, the business liabilities. It all flows through you. All income generated by the business is considered the owner's personal income and is reported directly on their personal tax return. And it's usually using what's called a Schedule C, profit or loss from business. So all the income flows directly through the personal tax return. The business itself is not taxed separately. The owner pays both the income tax based on their personal tax bracket and then self-employment tax many times with Social Security and Medicare on the net earnings of the business. So again, it is a sole proprietor is just the person who owns and runs the business. There's not a separate entity. How about partnerships? I have limited liability companies on the slide there first, but I want to talk about partnerships first because that'll flow directly to limited liability companies. Partnerships, each partner, so if you had two partners, each partner is subject to tax on their what you call distributive share, their share of the partnership income and loss. So if it quarterly or at the end of the year when the business is making money and the business distributes money out to its partners, and the business hands out $10,000 to partner A and $10,000 to partner B, those distributive shares are taxed, and it's usually determined in some respect on a partnership agreement. But if there's no partnership agreement, the law presumes that it's a 50-50 split. Then you have partnerships are considered pass-through entities. I mentioned before that with partners, it's kind of like a sole proprietorship with two people because the losses and the income flow through the individual's personal assets. And then those partners pay taxes on their share on their individual returns. LLCs, limited liability companies. I would say that this is the most common entity that people are using these days when they're setting up entities, at least in Ohio. I can't speak for the other 49 states. That's where I am in Ohio, in Cleveland, Ohio, a suburb of Cleveland. And LLCs are they operate like partnerships. I think I mentioned that earlier, unless the business elects to be taxed as an S corporation. And by the way, that may or may not be permitted depending on the language that's in the operating agreement. So be very careful about going online and plucking an operating agreement from LegalZoom or from Rocket Law, or I can't remember all the different websites that are out there where you can get things like operating agreements or partnership agreements online. So you need to make sure that you're very careful about what you do, what type of agreements you find. But so LLCs operate just like partnerships from a tax perspective, unless there's an election that can be made as part of the tax return process and a document that gets filed with the IRS that elects for the partnership, the LLC, to be taxed as an S corporation. Okay, what does that mean? So we have S corporations. S corporations, the owner is typically paid through a combination of some salary, so W-2 wages, the company pays me as an owner of the company, and then a distribution of profits. So as an owner, as a shareholder, I would be a shareholder under that S Corp. I get a salary, and then I have an entitlement to the profits that get distributed. And whenever those profits get distributed, it could be quarterly, it could be, whenever I want, and it could be just at the end of the year. From a taxation standpoint, the salary is subject to both income tax and self-employment taxes, just like a sole proprietor's earnings. And the distributions are generally not subject to self-employment tax, but they are subject to income tax. So S corporations they treat income, they treat dollars differently. And then for C Corps are much different from S Corps. Profits are first taxed at the corporate level. So the corporation pays tax on profits. And then owners who work for the corporation can be paid with salaries, which are taxed as income to the owner, and then are generally deductible business expenses for the company. So the company is going to pay me a salary, and then the company can take a business expense deduction for what they're paying, for what the company's paying me. Even though I'm the only owner, that's how I can structure a C Corp. By the way, C Corps usually work best with multiple owners, but that's another webinar for another time. And then there's dividends. So profits that are distributed to shareholders as dividends are taxed again at the shareholder level. And sometimes you'll hear the words double taxation, and that's what that means. So there's the money that the salaries that get paid to the owners, that's being taxed, and then the profits that are distributed to the shareholders are taxed again at that shareholder level. So I think that probably gets me right about to my 20 minutes of my portion of the webinar. Before I turn it over to Molly, who's going to get us into a new set of topics, I think are we entertaining any questions now, Lexi or Ruth, or are we kicking this off to Molly?
So we'll go ahead and turn it over to Molly Sullivan, but we will invite everybody to put questions in the Q&A. Phil can address questions live as they're coming in while the next presentation is going. And then if we have time at the end, we will circle back and do some questions live out loud. But in the interest of making sure all the content gets delivered, we're going to move on to Molly's part. Thank you so much, Phil.
Thank you.
Great. Thanks, Phil, for all that great information. So hello, everybody. My name is Molly Sullivan, and it's great to be here with you today. I'm actually going to build on what Phil shared with you by explaining how those different business structures or entities can affect Social Security disability insurance, which we call SSDI for short, and supplemental security income, which we call SSI for short. Those are the two cash benefits, disability-based cash benefits that Social Security administers. Before I dive into those details, I do want to just take a minute and share with you a little information about benefits planning services. So if you or if someone you work with would like one-on-one help understanding how business structures affect your benefits, you can reach out to a benefits planner, which is also called a community work incentive coordinator or a benefits counselor or work incentives coordinator. They go by a couple different names. Essentially, a benefits planner is a professional that generally works in a nonprofit or a state agency or some kind of an employment program, and they specialize in public benefit work rules. They provide free one-on-one counseling for people with disabilities about potential changes to benefits when working and how special benefit program work rules can be used to help maintain healthcare, maintain the cash benefit, or maintain access to the cash benefit, meaning keep eligibility. So in every state, there's at least one benefits planning program called a Work Incentives Planning and Assistance Program, or WIPA for short. And you can find the WIPA project in your area by using the Find Help feature at choosework.ssa.gov. Or you can also call 1-866-968-7842, or use the TTY number 1-866-833-2967. Now, in some states, the State Vocational Rehabilitation Agency also provides some benefits planning just as a part of their sort of menu of services. So if you or anyone you're working with is receiving services from a state VR agency, be sure to ask the VR counselor for help finding a benefits planner. And then another option is to contact your local Center for Independent Living and ask them for help with finding a benefit planner. If you're not familiar with Centers for Independent Living, they are nonprofits that support people with disabilities and living independently. Some of these centers have benefit planners on staff, while others may not have someone on staff, but often can help you find one in your area. So on this slide, slide 10, there's a link to the National Directory of SILs, and after I finish talking, I can drop that in the chat for everybody. So in short, there are a few ways that you, if you're receiving benefits, or a person you support, can get free one-on-one counseling around the effect of work on public benefits, including the effect of business structures on benefits. All right, so as I walk you through the next few slides, I'd like you to keep in mind that you don't need to become an expert on all these details. I think it's impossible for anybody to become an expert on all these details. Really, instead, the goal is for you to just begin to learn a little bit of the basics around the general effect of business structures on benefits. And then you're going to hear me say this a couple times, reach out to a benefit planner for more personalized information. All right, so with that, let's begin building your knowledge about the effective business structures on benefits. Thanks, Lexi, for turning the slide. So in a moment, I'll share information with you about SSDI, and then we'll look at SSI. But before we dive into those details, I just want to take a moment and frame this conversation, the part that I'm sharing with you. So the type of business structure or entity that a person chooses may affect the benefit really in two ways. It can affect how the business income is counted for benefit eligibility purposes, and it may affect how business assets are counted for benefit eligibility purposes. So really just sort of a high level framing the conversation. As we talk through SSDI and then SSI, we'll dig into this. We'll look at how income and assets are counted for each of the common business structures. That will really be kind of the heart of what I'll be sharing with you. All right, so with that, let's begin building your knowledge about the effective business structures, starting with Social Security Disability Insurance, which we call SSDI for short. So next slide. So to get us started with the SSDI part of the information that I'm going to share, I just want to make sure everybody knows some basic information about SSDI, just to make sure everyone knows which benefit I'm talking about. So SSDI is a monthly cash benefit that's based on a person's previous work and earnings. It comes with Medicare, and it's administered by Social Security. There are two basic eligibility rules for the SSDI benefit. First, a person must meet Social Security's definition of disability or their definition of blindness. And second, the person must have reached insured status, which simply means the person must have worked and paid enough into the Social Security Trust Fund. So when a person is found eligible for SSDI, the benefit amount they get is based on their average lifetime earnings. That means the benefit amount could be $300 per month or it could be $2,000 per month. The exact amount is based on the person's previous earnings. Now, the reality of the public benefit programs is that their names are confusing and they all sound way too much alike. So it's important for a person to confirm which benefit they have before they start gathering information about that benefit, since you'll begin to see there are some differences in their rules when we begin looking at each benefit individually. So there's a handful of ways that a person can confirm if they have SSDI. They can log into their My Social Security account. They can call Social Security or even look at recent letters from Social Security to see if they indicate which benefit the person has. When it comes to working, the general rule with the SSDI benefit is that the person will either get all of that monthly SSDI benefit or they will not get that monthly SSDI benefit. It's kind of an all or nothing sort of rule. And Social Security decides if a person is due that SSDI benefit by comparing the person's work activity to a thing called substantial gainful activity, which we call SGA for short. And in 2025, the SGA guideline was $1,620 per month, or $2,700 per month for people who are statutorily blind. Now, if a person's countable earnings are above that guideline, they would not be due the SSDI. And then if a person's countable earnings are below that guideline, then they would be due the SSDI. Now, there's some special work rules which I can't get into today, called work incentives, and they allow a person in some situations to get their SSDI and keep their SSDI eligibility status, even when their earnings are above that SGA level. For the sake of this session, there are only so many minutes that we have together. So I'm just going to touch on, like I did just now, that general work rule. But if you're interested in more information about how Social Security decides whether a person, their work activity is SGA or not, you can read the SSDI section of Social Security's Red Book. Or if you're the person who's receiving SSDI, I highly recommend you contact a benefit planner and request one-on-one support. Okay, now that I've set the stage for what SSDI is, let's look at the next slide and take a peek at what SSDI considers earned income to be with each of those business structures. All right, now we're going to start digging into the meat of it. So as Phil shared, there are a few common business structures and lumped them together in a table on this slide. Sole proprietorships and partnerships, limited liability companies, and corporations. If a person with SSDI sets up a sole proprietorship or partnership, Social Security will look at their net profits, and then they'll apply a deduction by taking the net profits and multiplying them by 0.9235. And the result is the person's earnings. Social Security calls this amount net earnings from self-employment, or NESE for short. Now, as I mentioned before, there are deductions called work incentives that may apply to lower a person's countable earnings for the sake of Social Security and comparing if the person's earnings are above or below SGA. And you can learn about those deductions in Social Security's Red Book or by talking to a benefits planner. But for now, what I want you to understand is that when you choose a sole proprietorship or a partnership as a business structure, that the net earnings from self-employment are considered earned income for SSDI. And I want to take a minute right now and just point out a common misunderstanding or myth. And that is, some people think that only the amount they choose to take out of their business bank account for personal use, which is called an owner's draw. Well, some people think that that's what's going to count as earnings, but that's not true. It's all in Social Security's rules. With SSDI, Social Security doesn't count owner's draw as earnings. They count net earnings from self-employment as the person's earnings. Really helpful detail to know. So moving down the list of business structures, if a person sets up a LLC, a limited liability company, and they stick with the default IRS tax filing, which is to be treated for tax purposes as a sole proprietorship or a partnership if there's more than one member in the LLC, then the same rule I just described would apply. So Social Security would consider that person's net earnings from self-employment to be their earnings. Now, if a person sets up an LLC, but they make the choice, they fill out a special form to do this, to file as a corporation. Generally, what happens in that situation is the person establishes a wage that the business will pay them, and those wages are considered earnings for SSDI purposes. And then in addition to that, there may also be profits that the business has, and those profits could also be considered earnings to the person. Okay, so that's what happens with an LLC that elects to file as a corporation. Lastly, if a person sets up a corporation, then generally the person is going to be getting wages. They're going to set themselves up to receive wages from the business. And the wages would be counted as earnings for the SSDI benefit. And in some cases, if there's also profits that the business has, those may also be counted as earnings. Okay, and I just have one last detail I want to point out about the arrangement where a person has a corporation or an LLC and they're filing as a corporation. If a person does that, it's really important that they set a wage that reflects their work activity, and even document the rationale for the amount of those wages. I think it's helpful to recognize that Social Security, they realize that a person in that situation is choosing to set wages at any level, right? They're choosing to set their wages to whatever they think those should be. And so if Social Security sees that the person's wages are below SGA, it can sometimes be a red flag. They may question whether the person is, the wages truly are just below SGA, or if the person is just choosing to set their wages below SGA. So given that, it can often be cleaner and simpler if you have an LLC to just stick with the default filing as a sole proprietorship or partnership. Then there's not a question of what did you base your wages on and how much are they based on your work activity or not. So some things to consider, and if you are someone who's receiving benefits and you do reach out to a benefits planner, I encourage you to talk through your situation with them. All right, so now let's pivot to the next slide and take a look at SSDI and business assets. Okay, well, this topic is actually pretty simple. I'm happy to report because the last one was a little complicated. So the topic of business assets and SSDI is actually really simple. Business assets have no effect on the SSDI benefit eligibility. And the reason for that is because the SSDI benefit is not affected by assets. There's no asset limit or anything for the SSDI benefit. A person can have any amount of assets and have SSDI. So regardless of the business structure the person uses, business assets do not affect SSDI. Now, I do want to point out a little statement at the bottom of this slide that's very important. It's a sort of a point of caution, and that is a person receiving SSDI may have other benefits. And it's possible one or more of those other benefits may be a financial needs-based benefit, like a person could also be receiving SSI, which is a financial needs-based benefit. And so those benefits, any really financial needs-based benefits, could be affected by business assets. And so that's why I feel like a broken record, it's really important to talk with a benefit planner about your unique situation, sort of talk that through. Okay, that was SSDI. We looked at business income and we looked at business assets. So now I want to pivot us to the second cash benefit, supplemental security income, which we call SSI for short. So this is a cash benefit that's based on financial need, and it comes with a type of health insurance called Medicaid. At least in most states, it comes automatically with the SSI benefit. And this is a cash benefit that's administered by Social Security. There's three basic eligibility criteria for SSI. First, a person must fall into a particular one of three categories. They must be either meeting the definition of disability, they must be considered statutorily blind, or be age 65 or older. And second, the person must have low assets or resources. I'm sort of using that term asset and resources interchangeably here. And so the limit for assets is $2,000 for a single person and $3,000 for a couple. And third, countable income also has to be low, and countable income has to be below in most states, the federal benefit rate, which this year is $967 for a single person. So if a person is eligible for SSI, the SSI benefit amount is the difference between that maximum SSI federal benefit rate of $967 and whatever countable income the person has. The difference is what their SSI benefit would be. Just a couple more sort of general points about SSI, and then we'll pivot back to business structure stuff. So there's a few helpful ways, I should say, there are a few ways that a person can confirm if they have SSI. So first, they could log into their My Social Security account if they've set one up, and that will show the type of benefit they're receiving. A person could call Social Security and ask them to verify their benefit type. It's also possible to look at recent letters, and it will say at the top which benefit the person's receiving. The last general piece of information I want to share about SSI is the general work rule with this benefit. So the way it works with SSI is that the person's SSI benefit amount is reduced when they have earnings. It's reduced by unearned income too. It's reduced by the person's countable income. But with Social Security, they are only going to count about half of a person's earnings. And so as a result, when a person has earnings, even with the reduced SSI check, the earnings and the SSI together are always more than just the SSI alone. So it's sort of the general rule of SSI in work. The SSI benefit does go down as earnings go up. Okay, so let's shift to slide 16 and look at what SSI considers earned income to be with the different business structures. And spoiler alert, this is very similar to what you will have seen when we looked at the SSDI slide about business income. So as a reminder, there are a few common business structures: sole proprietorships, partnerships, limited liability companies, and corporations. And just as I shared with SSDI, when it comes to sole proprietorships and partnerships, the SSI program will look at the business net profits. They'll multiply it by 0.9235, which is really just a little deduction. And the result is the person's earnings. And that's called net earnings from self-employment, or NESE. The only difference between what SSDI does and SSI does is SSI takes the annual earnings and just divides it by 12, regardless of the number of months the person was in business that year. Whereas SSDI will either average it out over the period of work. If the person only worked 6 months, they'll average it out 6 months. And in some cases, they might even look at actuals rather than averaging. But SSI is straightforward. They're always going to average annual NESE over the 12-month calendar year. Aside from that, they're very much the same when it comes to sole proprietorships and partnerships. Okay, so turning to LLCs and corporations, you'll actually see the SSI program treats business income the same as the SSDI program does. So if the person sets up an LLC and they stick with the default IRS filing structure of filing like a sole proprietorship or a partnership, then Social Security will look at the person's net earnings from self-employment as their earnings. If the person sets up an LLC and elects to file as a corporation, or if they set up a corporation, then generally those gross wages that the person will set themselves up to receive are going to be the person's earned income. And in some cases, the profits from the business could be counted as earnings. What can be a little muddy in the world of SSI is that the profits could potentially be counted as unearned income, which is not helpful in the SSI program, because the SSI program reduces the benefit, the SSI benefit dollar for dollar for unearned income. But you're going to see in just a minute when we talk about the business assets that generally a person receiving SSI isn't setting up a corporation or filing as a corporation. If they do that, there's a large issue that comes up around how the business assets are counted, and it can make them ineligible for SSI. So most people who receive SSI are not filing their business as a corporation or setting up a corporation. So let's shift to the business asset slide so I can explain what I'm talking about there. So this is a big topic. This is an important topic, this topic of business assets and SSI. So as I mentioned earlier, the SSI benefit is a financial needs-based benefit. And to be eligible, the person's countable assets must be below the asset limit. And that's $2,000 for a single person or $3,000 for a couple. So if a beneficiary goes with a sole proprietorship or partnership, the good news is that they could have their business assets excluded, meaning that they won't count towards the resource limit, by using a special rule called property essential to self-support. And we call that PES. We sound out the name, the acronym, it's called PES for short. So on the next slide, I'm going to go into some detail about PES. But first, I want to just sort of give you the full picture of SSI and business assets and business structures. So if a beneficiary, if a person receiving SSI goes with an LLC, they could use PES to exclude the assets in the business from counting towards the asset limit, but that's only possible if they file taxes as a sole proprietorship or partnership. Essentially, they're filing as an unincorporated business. If they elect with their LLC to file taxes as a corporation, or if they actually set up a corporation, the PES rule doesn't apply. And if the PES rule doesn't apply, that means the assets in that business are going to count towards the resource limit, and the person is very quickly going to kick themselves over the resource limit and make themselves ineligible for SSI. So that's why I mentioned earlier, most people who receive SSI are not setting up a corporation, or if they have an LLC, they're not filing as a corporation, because when you do that, you can't use the property essential to self-support rule. So just want to do one more plug here that I strongly encourage anyone receiving SSI or SSDI to talk with a benefit planner when it comes to moving forward with a self-employment idea. I just really, really, really strongly encourage someone receiving SSI to do that as well. Super important to have a conversation about business structures with SSI. Okay, let's take a look at the next slide, property essential to self-support, and then I'll do a quick recap and pass it over to Taliba. So as I mentioned on the last slide, PES is an important work incentive. In particular, it's an important work incentive for people who are receiving SSI and have set up a sole proprietorship, a partnership, or are filing their LLC as a sole proprietorship or partnership. So PES can exclude all the assets in a business, all the assets that are being used to operate the business, including liquid resources like a bank account. But for PES to apply, the assets need to be in what they call current use. And current use means you're using those assets in each month. They do have an allowance in the rules that they could still be excluded if you expect to use them in the next 12 months. So even if you didn't use a piece of equipment this month, but you expect to use it within the next 12 months, it can be excluded under PES. They even have an extension, an additional 12 months, where if you're not using the business assets, it could still be excluded if the reason you're not using the business assets is for a disability reason. Like if you need to go in for a medical procedure and stop working on using your business for a period of time. Now, there's no special form to request PES with Social Security. Instead, if you receive SSI, when you start a business, you want to make sure to keep a complete list of all the business assets you've got and a brief description of how those assets are being used in the business and even the frequency of how you're using them. Because business bank accounts are a business asset, I want to take one quick hot second and point out the importance of having a separate business bank account for your business. While every business owner should do that, regardless of receiving public benefits or not, that's important for all people who are self-employed or have a business to do, have a separate bank account. It's incredibly important to do that if you are receiving SSI and you're wanting that business bank account to be excluded. Social Security needs to see it is a separate, distinct account, and it's only being used for business activity. Do not want to muddle personal and business accounts together. Okay, so let me do a really super quick recap, and then I'm going to kick it over to Taliba. So Alexi, could you kick us over to the next slide? Awesome, thank you. So to recap, given the SSDI and SSI benefit programs have different rules, it's really important at the very start of your process to confirm which benefit you're receiving, or if you're supporting someone to help them confirm which benefit they're receiving. Second, I highly recommend anybody receiving SSI or SSDI to reach out to a benefit planner to get help thinking through business structures as well as everything else about self-employment and benefits to talk through their specific situation. Third, I want to encourage anyone receiving SSI or SSDI to create a great system for tracking income for your business and expenses for your business, so you can easily see what your net earnings from self-employment are each month, and so that you're prepared to share that information and report that information to Social Security. And lastly, I'd like to share a way for you to learn a little bit more about reporting self-employment activity to Social Security. There's a link to 2 different webinars that are on this slide. After I finish chatting and kick it over to Taliba, I'll drop the links to those specific webinars in the chat for you. But they are just sort of a step-by-step process for how you can go about reporting business activity to Social Security for those 2 benefits. So with that, Taliba, I am going to kick it over to you.
All right, so good afternoon, everyone. I know that it has been a ton of information between Phil and Molly, and now I am going to pile on some more information, and I hope that it is not system overload, but I'm happy that this is recorded because you can always rewatch this and take some notes, because you guys are really asking some great questions. I've been responding to a few of you all in the Q&A, and I can tell that we are absolutely not going to be able to cover everyone's question. But what I came prepared to add to the discussion that we are already having is really that sort of third and final level that both Phil and Molly hinted to, and that is, how the heck do you keep records of all this stuff? I almost feel like, some of you have already given up, because it's just like, wait, so I have to do this and I have to do that. And of course, Molly has said it several times, but before you hang up the dream of being a business owner, or if you're already in business, just trying to navigate what the heck all of this means, information is key. And so I applaud NDI for putting all of this together as being the perfect appetizer, the perfect start for you on that decision making, or if you're already a business owner, on the journey that you're already on, because it is absolutely possible to do both, to be a business owner and still be able to take advantage of the benefits that you deserve. So what I am going to cover today is really the record keeping part. In the interest of time, Phil has already done a great job, and Molly, on the business entity optimization. So I'm not going to get into any further into the weeds on the different types of entity structures. And I will just focus on the record keeping and some of the hot topics that I get in working with small business owners on what is deductible and what is not deductible, all of which is very important in the record keeping and making all of this make sense when it comes to what is counted towards your benefits. So we're going to jump right into it. I'm ready for the next slide. All right. So I always kick off my time with business owners in knowing the deadlines. Of course, you can always Google this, and that's why I'm not going to go through each row. But I do want to spend some time on the deadlines, because we talked about the different types of businesses and the different types of entity structures. And so the biggest takeaway from this slide is that based upon the entity structure that you are, or that you will choose to be, you may have a different deadline from that April 15th deadline that everybody knows about. So you can see here that if you are a sole proprietor, so that is without a formal business entity structure, your business performance is going to be reported on a Schedule C. Okay, that is a Schedule C, a tax form that is a part of your personal tax packet. So if you file taxes before, that first page of your tax return is the 1040. Well, the Schedule C lives within that packet. And so if you are a sole proprietor, just starting at that first line, then you do have that general deadline that everybody knows, which is typically April the 15th, unless there is a holiday in DC or some other reason why the IRS will give us a few more days. So I wanted to make sure I related that business entity type to the form as well. So Phil and Molly talked about partnerships, so multi-member organizations. You have a surprise here that I want to make sure that you know. So your deadline is 30 days before the deadline that everybody else has, okay? And your tax return form is a 1065, okay? And that is where you're going to be reporting your business's performance for that year. Now, why is it that your deadline is 30 days before? Well, as we've also talked about, your business has to distribute the profit or the loss to the members. And so we want to make sure that business owners are given enough time to get that information from their business and also file their taxes. So it's quite simple when you think about it. Because you have to distribute documents to the members so that they can file their personal taxes, the IRS wants for you to do that in enough time, so 30 days before. Also, we talked about those entity structures that elect to file as an S-Corp. Well, you can see here that if you are electing to file as an S-Corp, you also have a March 15th deadline, okay? 30 days before the general deadline that everybody else knows. And your tax form is an 1120S, okay? We talked about C-Corps. And just because a few people have asked, so public benefit corporations, as TMB is definitely different from what we're talking about when we're talking about SSI and SSDI. And so I saw a couple of questions asking for an explanation on public benefit corporations, which is what TMB is. But that is not the main topic of this. So I definitely invite those people with questions to reach out to me, and NDI is going to provide my information and we can speak further at that time. But us public benefit corporations, or B Corps, are treated like C Corps. So our deadline is April the 15th, or again, unless it's a couple of days afterwards, the corporation does file on that general tax deadline that we all know about. And that tax form is an 1120. Okay. And then finally, because I did see some questions about nonprofits, nonprofit corporations, you can see here that the deadline for nonprofit organizations is May 15th. Okay. And that tax form is a 990. So I already know you may have to, I told you, watch the webinar again. You are going to get the slides if you hadn't already received them. But this is important for you to, as you're making those decisions on the entity type, I want you to know when you are expected to be compliant with those deadlines as the entity type you chose. Next slide. So as promised, I want to go over the $1 million question that you probably came to this webinar to ask. And that is like, how do I know what is a business expense? Okay. You guys are telling me that, this may count, that may count, this may count, that may count. Well, what is a business expense? So let's jump into that part of it. And I'm coining this under the theme of what is deductible on this tax form we've just identified versus what is not deductible, what is not allowed. And so I like to give a general rule of thumb when it comes to what is a business expense. All right. And pardon me, but I'm going to try to keep it as simple as possible. And so the way that I frame it is, if it costs you money to make money, there's a good chance it's a business expense. Let's give an example. Your product is a t-shirt, okay? And so in order for you to produce this t-shirt, deliver it to your client, what all is involved in that process? Well, you got to have a t-shirt. So the cost of that t-shirt, the cost of the screen print, the cost of anything else that you are doing to turn around the t-shirt to your client. That is what I mean by if it cost to make that money for that t-shirt, then it is a direct correlation and high probability that it is a business expense. Y'all follow me on that? Now, next slide. I want to get into, with that said, I want to get into some red flag categories. I would be remiss if I did not adequately prepare you on your journey for the bomb record keeping and understanding that you may get a letter in the mail from the IRS asking you about certain things. So here's number one topic that may trigger some kind of letter. And I'm not in doom and gloom, y'all. I'm sharing this information proactively so that you can be bulletproof in your record keeping. I don't want to trigger you in saying, oh, I'm going to get a letter in the mail tomorrow. No, that's not how we're going to prepare. We are preparing knowing that if I am going to deduct in these categories, my documentation is going to be top tier. That's how we're looking at this. So large meals and travel deductions is a category that I want your record keeping to be top tier, okay? Because meals have had varying points of eligibility over the years, according to the IRS, on what even is a business expense. So I've had people ask me, hey, so I had a bona fide team meeting where we brought in food. We're at this table. We're talking about all things business. It's a team meeting. That's a business expense because you're having a team meeting in the furtherance of the mission of your business. I've had people ask about, hey, I am a realtor, or I am in the business of courting, I'll say courting or nurturing your clients. That could involve taking them out for coffee. Now, do I want to see all this money of you taking people out to coffee and not making any money? No. But if it is in your business model to nurture or court your clients before you're closing the deal, and you're taking them out to coffee, then, I am not saying that's not a business expense. I do just want you to limit it, okay? Now, let's talk about vehicles or any other like assets, because Molly talked about assets as well. So I want to dive into ensuring that we understand the difference between personal percentages of said asset and like what the IRS considers a business percentage. And so I'm going to just go with the car just because that's one of the top categories is mileage. And so if your business involves a lot of travel, mileage, anything related to the cross use of an asset, then I want you to listen in. So the IRS needs to know, particularly for those of us who may be claiming mileage for our business. So you're using a vehicle. One of the questions on that tax form is another vehicle available for personal use? What is the percentage of business that this vehicle is in? Okay, what is it? And so the best variable in that is mileage. So example, if you're in a normal commuting area, I'm in Alabama, so I'm in Birmingham particularly, and I'm going to say I'm in a normal commuting area. AAA says that the average annual mileage that I may get on my vehicle is between 10 and 13,000 miles total for the year. Okay, which is probably not average. It's probably a little high. But anyway, we're going to go with 13,000. So the way that I know, well, then out of this 13,000 miles that I've driven for 1 year, how many of those miles were business? So if this is relatable to you, remember, we're trying to have top tier record keeping on this. So there are mileage trackers. There are free apps that will help you do this. QuickBooks has a mileage tracker built in to all of its software packages. I believe even Wave does. But you're going to want to have that top tier record keeping to tell the IRS, out of the 13,000 miles that I drove for the year, 5,000 of them were business. And that is, in fact, how you arrive at the percentage of business use. And this is important because you need to know what is on, like what you're going to put on that business tax return in the area of business use of your vehicle. And really, it's the same formula for all of your assets. I think I have in here where we talk about home office. So if you are a business owner, you also have the option and the opportunity to treat a portion of your home as a business expense. And I think I have that on that slide, but I don't want to loop home office into red flag categories because it's actually not. So you see here, large meals, travel deductions. I talked about the business percentage of your vehicle, mileage. The other thing too is a continuous loss over year after year after year on your tax return, meaning, hey, I took a loss. I brought in 5,000, but I spent 30,000, and we're seeing a continuous loss over an extended period of time. I want to talk about that a little bit. And Lexi will have to let me make sure I keep my eyeballs on the chat because NDI knows that I get so passionate about stuff that I'll lose. I won't cover all my stuff. So for the piece of continuous loss, now believe it or not, the IRS does have this expectation and a guideline that for the first 5 years, it's possible that you may have a loss in your business. So I don't want anybody to panic, especially if you're a new business and you've spent more than you brought in, because that is a reality, right? And you're going to be spending your money to fuel your business. And so breathe in deeply. It's okay. But what I am talking about is, if we're talking about year 4, 5, 6, 7, 8, 9, 10, you are spending more now. Are you a hobby or are you in this for a business? That's where I want you to start. Again, having that top tier record keeping and speaking with a business consultant over what it is you're doing if you're always finding yourself in a loss and not necessarily for profit. Next slide. Okay, so I do have the home office business expense here. So I do want to talk about this, spend a little more time on this. The change that happened a couple of tax years ago when it comes to the home office deduction is that no longer W-2 folks can do this. So that's why I say this is a really good opportunity and a benefit for you to know about as a business owner, that this is particularly for those of us who may use our living space. That could be a rented apartment or a home that you have a mortgage on. If you are using some of your living space for office space, then I want you to also listen in, because it could be that you can take advantage of reporting the expenses for the usage of your living space. So remember how we had variables when it came to the percentage of your car. Well, the same thing goes when we are talking about our living space. And so what do you think that variable is? If it was mileage with the car, it is what with your living space? Square feet. I'm just trying to make sure I'm the last presenter, so I want to make sure I have everybody still. The variable is square footage. So you need to know what is the total square footage of the living space. So for example, if your home is 1,000 square foot total, okay, you have that variable. Now we need to know what is the square footage of the space that you're using for your business, for your office. And for example purposes, I'm going to say 100 square feet. So you've said to Leva, total 1,000 for the home, total 100 for the business. We have now declared then that your percentage of business usage of your living space is 10%. So now what does that mean for this particular form of your taxes? It means that 10% of your home expenses can be allocated towards the business. And this is where it gets into the, like, me incentivizing you to keep all these receipts or get into a QuickBooks account, all this record keeping stuff that I'm talking about, because What that means, we need to know what is your total cost of utilities. We're going to take 10% of that. What is your total cost of security? If you have ADT or something, or if you have home association fee, anything home expense related, okay, then it's a possibility that 10% of the total cost to that home in that cost category can be attributed to your business. Okay. All right, next slide. Because again, I'm trying to make sure that I am not running out of time. 3-minute warning. Okay, so you have the slides for the remainder of the piece, and this is what I'll go over just this piece here because I really want to leave enough time for everybody else. And I think it's something for you to think deeper into, particularly in correlation to benefits. And that is whether or not the IRS is saying you are in business or you are a hobby. And so it's important for you to do some studying on these slides because I have quite a few of them in here after this slide that goes into 9 guidelines that the IRS looks at when it is making a determination that you are in fact running a business, or is it that you actually are just a hobby. And so we'll go over general guidelines here, and then I'll go ahead and stop so that there are questions. So as I said, this is a real thing. I got this information directly from the IRS's website on whether or not they have deemed your business part of your taxes or business tax return. Is this a legitimate business? Are you in it to make a profit? And so they have said that, we'll consider it a business if you, and if we say that you're a business, then you can deduct. Remember how we talked about all of those deductible versus non-deductible, and I talked about the loss having a negative number maybe because you brought in less than you spent out. Well, if the IRS agrees that you truly are in business, then you will be allowed to claim that full cost to you. Your tax return will allowed to be negative, meaning you can accurately say, I brought in 5,000, and because I mean to have made 10, but I only spent 10, so I'm negative, it will allow that negative difference. However, if for whatever reason you get this letter, it's asking you to prove that you're not a hobby, then if you don't have that documentation in order, right? Again, the remaining slides has all the topics on how you're going to do that. Then your tax return will be limited to just breaking even. Okay. And the reason why I wanted to throw this on top of all the other information that you've received in this session is because I think it's very relevant and a very relevant option and something for you to consider as you're having this discussion with your benefits planner or with an attorney as you're forming whether or not which entity type you should be choosing. But I think that it's sort of that other kind of icing on the cake to know that there is a difference and there can be a determination by the IRS based upon how you've been filing taxes on whether or not you truly are considered a business and have this business income that Molly has talked about, or if you're just you're not intended to be a profit and you're really doing this for a hobby. So I am going to stop there just because I see my friend Caroline coming on. I'm not going to go over anything else. I know we got to do the post test.
Yeah, everyone will get the slides.
Yeah.